Okay, so let's move on to the next piece then. We're going to be talking about savings rates. There's new products coming out. There's been pressure from the FCA on the banks. What have we got for this piece?
So it's been an interesting news week. We've had the FCA meeting with banks to put pressure on them to pass on the rate rises that have been going on. So to give you an idea, we've seen the Bank of England raise the base rates now at 5% as we make this podcast. But we're seeing mortgage rates go up, but savings rates aren't going up at the same rate. So it means that banks aren't passing on the rate rises to savers and passing it on more so to mortgage borrowers. So that means on that differential that they pay out to savers and what they get from people they loan money to, that's their margin and they're making more profit. So there has been pressure put on the banks to reduce that margin. And that will hopefully mean better rates for savers, but also improved ones for mortgage borrowers. So you've got to think about, at the moment, there's been calls for the government to step in and help mortgage borrowers because rates are rising. Now, I covered this on last week, why that's obviously unlikely to happen. Because of monetary policy, when the Bank of England is moving interest rates, it's trying to cause pain. It is trying to encourage people to save money because there will be more attractive savings rates. So it takes money out of the economy. People save it to earn a return, which means they buy less stuff, which means therefore inflation hopefully will start to calm down and we actually see the inflation rate fall. That's the theory. I covered last week as why that won't necessarily work in practice at the moment. Certainly not as efficiently as it would have done in the past. With mortgage rates, we've obviously seen them rising. And we've got a lot of people still on fixed rate deals, so the pain isn't filtering through to as many people as it used to because they're still on their fixed rate deals and have yet to come off them. Now, one thing would help is if banks passed on the higher interest rates, then that would obviously encourage people to put money in savings accounts and it would draw money out of the system, so out of the economy. And of course, in some ways, if we see that margin squeezed, so it means banks are offering more competitive mortgage rates as well, that might ease a bit of pressure on people who are borrowing and who are seeing their mortgage rates go up. Now, you've got to see it from another perspective as well. What's happening, if a mortgage lender offers a very attractive mortgage rate, immediately they get flooded in the market. They get flooded with applicants. And it's a similar thing that happens when you get banks offer the best savings rates. So as soon as you get the best rates, they then pull them. And so you can get this scenario, particularly with mortgages, where banks will say that they can't sustain or maintain good customer service levels if they get flooded with applicants. So they end up trying to almost dissuade applications by offering uncompetitive rates. And what happens, you can get this vicious circle where the rates keep going up, even though the Bank of England is perhaps, well, they're not necessarily reflective of what's going on with the base rate, for example. So the FCA are trying to make banks play ball a bit more, stopping them profiteering because they're being accused of that. So one message for people listening to the podcast, make sure you shop around. Because if you stay with your existing bank, you're not guaranteed to get the best rates. If you go to podcast 396, we talked about how you can get 7% on your savings with products from the likes of First Direct, who offer regular savings accounts that pay a very high interest rate, but there are limits on how much you can put in a month. If you go to episode 277, we talked about cash ladders, not as effective in a world where rates are going up, because actually rewarded for just locking money away for longer. Because if you think rates are going to keep rising, then it isn't as attractive using a cash ladder. And of course, there's cash savings platforms. These are the platforms that exist where you can move money between savings accounts more easily rather than having to go to each banking institution each time you want to put money away and open accounts. There's one platform online that allows you to move money between different banks as your cash matures, let's say from a fixed rate bond. And we talked about that on episode 291. So for people who are fed up of banks not passing on the Bank of England base rates and not increasing their interest rates, there is a new account that's come out that tracks the base rate. So when the Bank of England increases the base rate, within 3 days, the United Trust Bank's new account will increase their rate in line with it. So this new account is a 180-day notice base rate tracker account, and it currently pays 5% interest, and that's gross. So that is the current base rate. So if the base rate goes up, this will follow that, but if it gets cut, it will also follow it on the way down. So there is a catch, of course, there always is. You have to have £5,000 to use this account, and there is a 180-day notice period. So if you want to take money out, you have to give 180 days notice to get your money out of that account. So how does this new account compare with what's out there already? Well, interestingly, you can get a bit more than that if you're willing to lock your money away. Now, there is a notice account that's only 90-day notice that's from BLME, so that's the Bank of London and the Middle East, that offers 5.09%, and that is a minimum of £10,000 you need to have that account. And there is an account from DF Capital that offers 5.05%, and it's again a 90-day notice account with a smaller minimum amount of £1,000 you need to open it. We'll put a link in the notes because these things change regularly, so you can see the latest rates. So for comparison, you can get accounts with a shorter notice period that offers just a bit more interest, but they're not linked to the base rate, so you have to bear that in mind. But if you're willing to lock your money away for longer, so fixed rate bonds, you get a 1-year fixed rate bond with an interest rate of 6.1% from first save. You need £1,000 to open that account. 2-year, you can get a 6.15% interest rate, and again a minimum of £1,000. We'll put a link in the notes of this podcast so you can see the latest interest rates on all of these accounts, because they do change regularly. And of course, you can have easy access accounts that offer a 4.35%. Again, we'll put links in the show notes. It's not as much as the tracker account, but that is still very good for an easy access account, and that is among the highest rates we've seen since the financial crisis. So in summary, make sure you shop around. There are now new innovative products that are coming out. You can get products that do track the base rate if you are unhappy with the fact your bank isn't passing on those rate rises. And from experience, do keep an eye out for innovative products. We'll bring them to you. We'll talk about it on the podcast and have them on the Money to the Masses website. But in the past, there were very innovative products, like products that give you an average of the top 5 accounts, things like that were available. I think we might start seeing more innovative savings products going forward, but we will bring them to you.